Hello, folks, and welcome back to another edition of the LiveWire. Today is February 9th, starting out with a Monday. And Monty, good morning. Anything you'd like to start off with, sir, or anything that's catching your eye in the markets this morning?
Yeah, good morning, CJ, and good morning to everyone watching. There is plenty to discuss today. Equity markets looking rather strong as we start the week here, which is an encouraging sign if you're an equities trader, but Bitcoin not looking as hot. And I want to talk about some potential catalysts as to why Bitcoin may be underperforming in the interim and why we may see continued underperformance relative to the equity market. And I want to do that through some on-chain data and then also some off-chain data. Take a look at ETF net flows and also Treasury net flows to see kind of where Bitcoin's at and what it's going to take to kind of pull us out of this tailspin that we're in for Bitcoin. So excited to dive into things, but if there's anything you'd like to start with, please feel free to do so, my friend.
You know, I think it'd be nice for you to start with like Bitcoin, maybe a broader overview, and then I have more of like equity and more macro things I'd like to talk about, which I think would be probably better for the later half of the show. But I mean, what do you make of that 13% bounce in Bitcoin, and where do you think that kind of leaves us right now?
Yeah, that's a good question. And, I think a lot of people are wondering the same thing, kind of where we're at following that big bounce. But for me, not much has changed in terms of, this candle doesn't mean all that much given the fact that we saw such significant sell pressure into this candle. You can see that the sell volume was pretty immense. We were due for a snapback, at least towards the moving average. From purely a technical perspective, we were oversold here for Bitcoin. And even though, we're expecting price to go lower, that doesn't mean we expect price to just drop like a falling knife like we got in the last week here, in the last 10 days. Price typically grinds down a bit slower. But even when we do get these moves down, oftentimes we get this reaction rally where, people get really short here in the futures market and they try and play the downside and then they end up getting liquidated and price bounces back. So right now, Bitcoin kind of consolidating just below 70K, down 1% today, despite the fact that we have, the Qs up over 0.5%, NASDAQ up, and then, the Dow up pretty significantly as well. So, you got to wonder what's it going to take for Bitcoin to perform well. Well, I think there's a couple things we can look at to kind of determine when that may happen. And one thing that I'll get to this in a second, but one thing I want to talk about first is some on-chain data, and that's relative unrealized loss. And all I want to highlight here is that we're just reaching neutral territory for relative unrealized loss. During other historical bear markets, we've far exceeded the overheated level, which is one standard deviation above the neutral level. And as you can see, typically it's not until we have major losses at play that the market does reach a bottom. And typically, we are well beyond the overheated level when we're making the market bottom. So don't think that this market can't go any lower. Right now, we're kind of sitting at a very neutral level in terms of relative unrealized loss. But I think in order for a market bottom to occur, we're going to need to see something like this or like this, where you see massive losses realized across the board and mass capitulation. That's typically when you see a market bottom. But moving on to some off-chain data, one thing that I think is going to be very important and has been very important historically is the spot ETF net flow and the government treasuries net flow. So the spot ETF net flow is this kind of teal line here. The government treasuries net flow is the red line. So just a little bit less of extremes with the government. They're a little bit more disciplined in terms of, buying and selling. But as you can see right now, both are flowing out. So we're seeing net flows from government treasuries and from spot ETFs. That is typically a sign that we are going to get continued sell pressure. But one thing I think that is really interesting about this chart is that if you look at historical market cycle bottoms like what we had in April of 2025, you can see that before we had that, we had a low in the spot ETF net flows. And it really started to climb out of this trough here and cross over this midline before price really caught up to it. So spot ETF net flows can be a leading indicator for price. And looking at the converse side of that as well, you can see diminishing returns in terms of how much they're investing into the market, you can see the spot ETF net flows are diminishing time over time. That's a good indication that here was the market top, that we're experiencing some signs of exhaustion. And without these big market participants, kind of reaching previous all-time highs, this market was doomed to see some negative sell pressure. So one thing that I think is very important to keep in mind is that oftentimes the market won't make a bottom until we see spot ETF net flows start to really turn up. Same with government treasuries, just to a lesser extent. They're still very important to look at. And right now, they're both just starting to trend down after, a period of trending higher. So, this was kind of, I think, a lot of people targeting that 100K price level and expecting Bitcoin to reach 100K. We didn't quite get that. So now we're seeing sell pressure. And in terms of what that's doing to price, just taking a look here, we're a few percent off the low here at 62,000. We ultimately kind of bottom at 60.5 thousand. But I think that given the fact that we're seeing spot ETF outflows, we're seeing government treasury outflows, and then in conjunction with the fact that realized losses are actually at a relatively muted stage, tells me that we have much more to the downside in terms of interim price action for Bitcoin. So, CJ, we talked about market cycle timing and how long it typically takes for the market to make a bottom. I think that we won't see a Bitcoin market bottom until maybe September or October. I think we're going to see a grind down until then. And that's just based on what I'm seeing on chain and then also what I'm seeing off chain and what it's going to take for price to go higher. I think the catalyst of ETF net flows is a big one. So I'm going to keep my eye on that chart and ultimately, stay short until something in that regard changes. So that's what I'm seeing for Bitcoin right now. But if there's anything you'd like to add, please feel free to do so.
Yeah, that's a very interesting metric when looking at digital asset treasury companies. Difficult question, but would you imagine that some of those will be forced sellers or even experience bankruptcy? Not the majors necessarily like MicroStrategy or BMNR, but could you see that as a potential catalyst for a market bottom?
Yeah, yeah, and I don't even think BMNR and MicroStrategy are safe. I don't think that I could see a market bottom where both of those companies get completely eviscerated, and it's not until that happens that we see a market cycle bottom. So, I do think that, um, typically when you're dealing with that much relative unrealized loss, you're going to see some bankruptcies of smaller companies and smaller holders, and you're going to see some ETFs collapse as a result. But there will be some that rise out of the ashes, and I think it's going to be important to keep an eye on those ETF net flows. So, yeah, good question. But I think that in 2026, I don't really think anyone's safe from bankruptcy when it comes to Bitcoin.
Yeah, that would be a great indication of a market bottom, I think. I think there's a couple things, like one, Trump possibly being removed because he was dubbed, the crypto president or whatnot. That could be an interesting market catalyst for a bottom, but we'll just have to wait and see. A lot of this stuff is very interesting, though. I will say I am starting to like Bitcoin a little bit more because I think what we're seeing from the popular folks on Twitter, like the perma bulls, the Tom Lees, the Raoul Pauls of the world, have kind of been humiliated and forced into accepting the 4-year cycle idea now. And it's kind of ironic, once the market participants accept that 4-year cycle idea, that might increase the potential for some type of small counter trend rally, potentially puts in the macro lower high before heading to that final, negative 70% drawdown area of roughly, 37 to 40K. That's kind of my base case. I'm pretty sure it's your base case too,
Yeah.
but let's just see what happens.
Yeah.
Anyways,
real quick, that ties in with a question here. It's a pretty good one that we could hit real quick. So it's from Nod. He says, I'm looking to establish a brand new long Bitcoin exposure. Is there any entry level that gives you comfort that this most recent down move has calmed?
well, I think it's all about your perspective and your time frame. Personally, my plan, like I just said to Monty, I'd like to see the things that we've seen in history somewhat repeat. So for instance, the average bear market, you know, if we project it out and forecast it to 2026, then we should look for a bottom in roughly September to October. And if we're looking at average drawdowns from Bitcoin's peaks to lows, they average roughly 86%, 80%. Last cycle was 77%. So if we assume a 70% correction, then we're looking at, 37 or 40K. If you want to scale in, that's up to you. I would just be cognizant of those potential downside risks because that's just what it's done historically. So if we assume this time is not different, then we should be prepared for those type of price action moves.
Yeah, absolutely. And just to add to that point, Bitcoin, when it does move, it tends to move in a very parabolic nature. So the move to the upside is going to happen very quickly. That's what we've seen historically, and I think that's what we'll see again here. So I don't hate the idea of scaling in as we move down, because really, what's the difference between a cost basis of 60,000 and 45,000 if you're looking at a 200K price target? So like you said, a lot of it has to do with your time preference. But for me, I don't really hate the fact of buying Bitcoin right here and holding it for the long term. I'm waiting personally to inject capital into this market until we see some lower prices. I think that the realized profit and loss, and also like CJ talked about, the market cycle time that it typically takes to make a bottom, we're very much in the early stages of this bear market, in my opinion. So I'm waiting to inject capital in this market, but I think that once we see ETF net flows start to turn up, once we see large specs start to invest back into this space, I think that would be a good time to buy. So it's not so much about a price for me, but it is more about sentiment and positioning of some of the large players. So hope that answers your question, Nod.
Love Nod's questions as always. We could talk about Bitcoin all day, but I think the last thing I'll say about it is it's shocking to me how a lot of folks, at least in popular media, are so surprised by this Bitcoin sell-off and saying there was no way to see this coming. There's no reason for Bitcoin to be down this much with gold, silver, the S&P. And the reality is that Bitcoin's just doing what it's always done.
Yep.
So, all right, let's move on to some equity charts.
Yes. What are you going to start off with today, my friend?
Well, I just think it's pretty shocking looking at the difference between the NASDAQ, the Qs, the S&P 500, and the equal weighted S&P 500. I don't think, like, last week was pretty rough, right? Like we had, a decent sell-off, or at least for, 3 days, and the Qs almost broke down. Same with VU here. But when we look at the stuff like the equal weighted S&P, they're still like making new highs as of Friday and then once again today. So, I think the rotation in this market continues to be quite strong, and it's hard to fight something that's at all-time highs. Something that I've been talking about and focusing about in terms of the AI trade that hasn't really been talked about as much as, more interesting, flashy topics like critical materials, or for instance, nuclear energy, is just old-fashioned crude. WTI has really been trending up for the last few days and just really continues to be pretty strong, especially during last week's sell-off within equities. And when we look at USO, the United States Oil Fund, it continues to kind of look strong and be bid here for the foreseeable future. And when we look at, some of the companies involved in this type of oil production, obviously Exxon looks a little bit overextended, but I just don't really hear a lot of folks talking about, the demand for oil and natural gas also being part of the AI trade, because even though those won't be the final energy producers like nuclear we'll still need them in the interim while everything else is being built out. So just a few companies and ETFs that have kind of caught my eye. Haven't taken any positions in these, but they just look, they've been working, right? And not a lot of folks have been talking about them. For instance, OIH is the VanEck Oil Services ETF. It's recently broken into a new high and has really trended really well in the last few weeks. So I always think it's interesting when you see something that's working and not a lot of people are talking about it and it's not super popular, because sometimes it has a chance to continue. Another one that's similar and lagging a little bit behind OIH, but it's also done fairly well in recent weeks, is XOP, the gas and oil exploration and production ETF. And this one's kind of interesting, and I would like to see AJ's opinion on this, honestly, because it looks like we do have a little bit of a inverted macro head and shoulders pattern here, following the event in 2020 where oil clearly went negative. So we'll see. And I also think oil is a decent hedge against any like equity exposure in case this Iran thing continues to escalate. And even if it doesn't, I think there's still reasonable, reasons to be long. And if we're looking at, obviously Exxon is a $500 billion company. But if we're looking at some of the smaller companies that have done quite well, Rig is one, Transocean. This is only $5 billion, or I guess $6 billion in market cap now. But it's really done well ever since April. It's up from 2 to 5. And these are things that will likely benefit if the price of oil does in fact go from roughly 60 to 90. If a situation like that occurs, I think it's interesting to look at the possible companies and areas of the market which would be the greatest beneficiaries. So from that perspective, just a couple names that I thought have been moving. But yeah, have a little bit of a small position in USO. We'll see how that goes, but it's mainly just a hedge against, equity risk if, conflicts continue to just get worse. But
Yeah, I think that's a really good way to play this right now. But I just want to pose a question to you. And you've talked about this briefly before, but I don't think it hurts to reiterate. But what do you think are some of the greater market implications of rising oil prices in terms of like inflation, in terms of what it might do to the dollar? What do you think, if we do get those continued prices in oil like you're expecting, what do you think that does for kind of the greater market?
it's a great question, and I'm glad you asked, because crude oil, if you study commodities as well as economics, it is without a doubt the most important commodity when analyzing fluctuations in inflation. Part of the reason why inflation went up to 8 and 9% in 2022 is because of the parabolic rally in crude that we saw. Now, there were other issues as well, including supply chain dynamics somewhat breaking down, but still. And also, when you look at historic inflation cycles, doesn't have to come back in 2026, but if you were to look at, inflation cycles from a historic perspective, the forecast from for 2026 is to see a rise in inflation. Larry Williams has done a lot of work on, those cyclical patterns, and it doesn't have to play out, of course, but it is setting up to play out in 2026. And look, so far, crude has been going up and kind of fulfilling that idea. So I don't really want to fight it up until this point. To answer your point, though, for broader ramifications, yeah, if inflation starts to creep back up, and we have, a more hawkish Fed than initially anticipated, then that could definitely throw a wrench in some of the long equity ideas, because the whole thing, aside from AI driving the bull market, in my opinion, is the expectation of lower rates and continued injections of liquidity into the market. But if you have inflation creeping up, it's much more difficult to do those things without exacerbating the problem.
Right.
So,
Yeah, yeah, good stuff there. We'll see if that historical correlation continues to play out as oil continues to rise. But I think that's something that you definitely should prepare for if we do see continued oil prices, because historically that's what we've seen. So good stuff there. But I want to talk about something that we have actually talked a lot about, but I think is still worth mentioning today, because I was having a little bit of PC trouble, and I went to look for some new parts for my PC, and everything was somewhat reasonably priced, besides the GPUs and the RAM. If you want to buy a GPU right now, or you want to buy dedicated RAM, it's going to cost you an arm and a leg, and it's ridiculous because like I was looking, it's almost cheaper to buy a pre-built PC than it is to buy these individual components because these companies that buy or that build these pre-built PCs are sitting on a stockpile of supplies and aren't paying the same amount for RAM that we're paying on the open market. But getting to the nitty gritty of things here, I think that a chart that's worth watching is actually AMD. Now, AMD, of course, is Advanced Micro Devices, and they are a company that benefited tremendously from the AI trade. And as you can see, all throughout 2024 or 2025, excuse me, we saw positive price action, big gap up here that you need to be cognizant of. But we also have this smaller gap to the upside here that I think can fill in the interim. Right here, this gap can fill in the interim and see price go higher. So I'm exploring some actually options. They're a little bit pricey right now for AMD, but I think that we do have a chance of going up to reach previous all-time highs. And that's based on the fact that, if you're building a computer, you basically have two choices, NVIDIA or AMD. And right now, both are seeing incredible surges in demand due to the AI trade, and it makes it tough for the retail consumer to get their hands on the end product. But what this tells me is that the demand aspect isn't waning yet. So the fact that we're still seeing, green price here, and the fact that we're still seeing, massive, massive markups on the price of GPUs and RAM tells me that demand is still very, very high for these components. So I think that we can see continued positive price action in stocks like AMD and even in stocks like NVIDIA, which NVIDIA looks a little different, but ultimately kind of the same. 2 days of very bullish price action, breaking above that moving average and looking to make a run at the previous all-time highs. So I think that, we're not seeing that rotation of capital just yet that we've been talking about in terms of, the AI trade being dead, and we're seeing money flow out of NVIDIA back into more consumer staples. I don't think we're at that point just yet. I think that the demand for dedicated RAM and the demand for GPUs is very much still alive, and that's reflective in the price of those assets, and then also the price of NVIDIA and AMD. So I think that that is still a good trade with more upside than people realize, and that's just based on the fact that the demand is still through the roof for the devices that they're selling. So CJ, unless you can go to Taiwan and solve this processor crisis, I think that we see continued demand growth for GPUs and dedicated RAM.
Well, I think you'd be surprised if you really knew what I was working on. I actually blew out a RAM stick in my PC
Oh no.
this weekend, and so yeah, didn't like hearing what you just said.
Yeah, it's going to cost you a pretty penny to replace that.
I think I'm just going to buy a new computer, to be honest with you.
Yeah.
We'll see. But I didn't plan on talking about this topic, but I want to ask you about it because there's something I was thinking about a lot over the weekend. And Bitcoin, when you compare it to software ETFs, it basically looks the same. There's been a tremendous downturn in software companies. And we also have a new innovation in crypto where Hyperliquid is making futures markets as well as, I think, spot markets for private companies. Now, these don't represent shares or ownership in these companies, but they're offering the ability to speculate on things like OpenAI, Anthropic, right? That's the company behind Claude, and even SpaceX, right? So, we think about the last decade of how software was so, instrumental in the Mag 7. That was really the best trade of the last decade, at least one of them. And looking ahead to maybe the next 5 years or the next decade, these systems are only growing at exponential rates. And if you think about a company like Anthropic, what if that has the ability to displace virtually all of people who have, wrote software, and it really makes, or at least those people who have wrote software now have a machine to increase their efficiency by, 100% or whatnot. could you see a company like Anthropic and like that this massive displacement of software becoming like a Google from 2010 to 2020 in terms of that super cycle? I mean, is that something that you've like thought about or kind
Yeah,
of?
yeah, I think that's a really important thing to think about in terms of kind of where we're at in this current market cycle. Because, like you said, throughout the last decade, software has been arguably the best trade you can make. Stocks like Microsoft have performed incredibly well, but in the last calendar year, we've seen a real switch to hardware and true restrictions on the output of these machines based on the amount of hardware that companies like Anthropic or OpenAI can literally get their hands on. But like you pointed out, these companies aren't growing at a linear scale; they're growing parabolically, and that's just due to the nature of AI, right? Um, and one thing that I think won't go away, I think that maybe, like you said, AI can take over kind of the software element, but I think that one thing that is very important to consider, and I think that will be important going forward, is that stocks like OpenAI and stocks like Anthropic require an incredible amount of cloud storage. So I think that that could be the next kind of big trade is people investing in cloud storage companies, and
Well, that's
those companies,
Amazon,
yeah,
right?
Amazon has benefited tremendously from the AI trade indirectly, but nonetheless, AWS has been a massive benefactor from the AI trade. So, even companies as big as Amazon can be impacted by this trade. But I think that we'll see a rise of many smaller companies that offer cloud storage services that become one of the better trades of the next 10 years based on the fact that AI is growing at a non-linear scale. It's growing parabolically, and the demand for cloud storage is going to be something that increases at a parabolic rate alongside the growth of AI. So I think that right now what we're seeing, and you've talked about this with your discussion of crude oil, but what we're seeing right now is like this kind of flow of capital where you see the hardware right now is still the biggest benefactor of this demand for AI. But I think that eventually that's going to go downstream, and you're going to see energy stocks and cloud storage companies really perform well. So for me, that's kind of the next step in this cycle is seeing that flow of capital into smaller cloud storage companies and seeing a rise of kind of cloud storage and also energy companies as well. I think that you hit that nail on the head that, you know, um, energy is massively in demand due to the use of AI. And I think that crude oil or even some of the solar plays that you brought up are great plays in the current market conditions. So, yeah, I hope that answers your question. But I think that, um, we see the continued growth and continued demand. And that's reflective from my experience just trying to purchase some RAM. So, yeah.
It's always nice to hear your opinion and your perspective because I think people appreciate it as well. But that's an interesting topic, and I definitely think we're going to hit on it more in tomorrow night's member webinar. If you'd like to get access to that, among a lot of the other stuff that we do for the trading community, trade insights, weekly reports, trade ideas, research. You can get a 2-week free trial at the QR code below, or if you just go to stickytrades.com/cryptex, you'll be able to get that free 2-week trial, no risk involved whatsoever. But thank you guys for tuning in. I hope everybody's having a good day out there and prosperous week. And we will talk again soon.
Take care, everyone.